So we're going to spend 40 minutes or so here talking about the current setup of the various option indicators and some other things that we look at. Just in case you're not familiar with our company, I started as a derivative research firm about 30 years ago after coming off prop trading desk on Wall Street. And then since we had quite a bit of success actually in the 2008 bear market, people asked us to move into money management, so we did both as in the futures area and in the stock area. And then we also have certain educational events such as this or a mentoring program as well. We had a great year last year in our managed accounts, and I'll show you a link to access some of that information at the end. And our newsletters were quite profitable as well. Of course, past performance is no guarantee of future results. So this is a special we'll be offering today to all attendees, and I will be coming back to it later, but we have a brand new home study course, 14 different sessions ranging from beginner to advanced, and we're offering that with 50% off. So I'll mention that again later. So there's four main indicators that I look at. Number one and most important being the chart of the S&P 500, and the current market that we're in, there's no better time to describe how we use that than right now. We also will look at equity only put call ratios, market breadth, and VIX. As we get into this, we'll see that some indicators are, well, we really don't have much in the way of oversold right now. But we believe in waiting for confirmed signals. So oversold does not mean buy. Oversold markets can continue to decline for quite some time, as we saw in March of 2020. But on the other hand, overbought does not mean sell either. So we have had some overbought situations here this year in particular. Really, I mean, probably in the last since March of 2020, we've had quite a few overbought conditions, but none of them have really been worth selling unless you have confirmed sell signals. So here's a 2-year chart of the S&P just to kind of give you an overview. There's only one oversold condition on this chart, that's March of 2020. We have, however, had a few overbought conditions. There was February of 2020, and that was a pretty good one. September of 2020 also pretty good. And then this year there's been a couple that have had small reactions, but not very long lasting. And now we're off here to the races again, turning up near new highs this afternoon. And yet we're not really overbought right now, as you'll see. In fact, a lot of the internal indicators in this market are not really doing all that well. So currently there's a little support right here at this level, which is 43.70. That was last week's low. And then these bigger, more well-tested support areas below that. But right now, I think 43.70 is a pretty important number. If we fall through that, then we're probably at least another quick 100 points to the downside to the next support level. And then who knows, once you get momentum going on the downside, things can happen quickly. So right now, the trend of the chart is upwards, and that's really what the main thing is. If all your indicators are saying sell, but S&P is going up, you have to go with S&P. And in some sense, that's almost what's been happening lately. But the trend of the S&P chart is up. There's resistance at the all-time high, 44.30. I mean, we're right almost there, 44.23 on the close today, right at the high of the day. But that first support level at 43.70, there's a little tiny gap there. If that gets broken, then I think we're going down to test the 42.33 level, which I call the crucial level, because if that one is broken, then you're probably really looking at a bear market beginning. But none of that's really happening right now. We're up near here, and everything is positive with the S&P chart at the current time. Now, there's another thing we look at on the chart is what we call modified Bollinger Bands. When John Bollinger invented Bollinger Bands, he used as the definition of volatility the standard deviation of daily closing prices, which seems pretty reasonable. But in the math world of Black and Scholes, and as they were inventing the Black-Scholes model, and many other academics use a slightly different definition, and that's the standard deviation of daily percentage price changes. So that's a slightly different number. It gives you a slightly different Bollinger Band, but we need to use this in our business because we need our volatilities to agree with those of Black-Scholes in the option business. So we plot the 3 and 4 standard deviation bands, and when the market moves outside of the plus or minus 4 standard deviation band, and then moves back inside the 3 standard deviation band, we get a signal. So we've had some great signals from this in the past. Right now, we're on a sell signal that occurred about 2 weeks ago. These are more intermediate term indicators that don't just give a signal and react right away because they're based on a lot longer time frame. But here's the 1-year chart of the S&P with these modified Bollinger Bands on it. So there's the plus 4 standard deviation band, and then just inside is the plus 3 standard deviation. So you can see that here we were outside, then we went inside. That was a sell signal, and the sell signal's target is the lower minus 4 standard deviation band. So last September, that was a successful signal. This one took a little longer to develop, but eventually did over here hit the lower band. And this one was a false signal. I mean, it was a losing signal. And then we've come up, and now we've just gotten another sell signal here right around the middle of July. So we're working on that one right now, and it's in green because it means it's a current signal. Normally on my charts, a red letter such as the S back here, that indicates a successful signal, and a blue letter indicates unsuccessful. So we have an actual service for these. If you're interested, we can do these volatility band signals on any stock, index, or futures contract, and they're actually quite useful. So subscribers to this service get an email every day telling you what's setting up and what's confirmed as far as these buy and sell signals go. So the second area that we look at is the put-call ratios. And put-call ratios were invented as an indicator by Marty Zweig back in the 1950s. And we use the equity-only put-call ratio, in other words, all stock options that trade. We use that to predict the broad stock market, and I'll show you why in a minute. But Marty realized when he was looking at the original data, which was very sparse, and basically he was getting it out of the ads being run in Barron's by the put-call dealers, that too much put buying is actually bullish for the market. If you see a lot of put buying going on, the market went up. If you saw a lot of call buying going on, suddenly realized the market right after that went down. So he's got this, as a contrary indicator, and it's proved pretty well over time. The simple one is the standard ratio. Let's say on IBM, we sum up the volume of the puts traded today and then at the end of the day, and then we sum up separately the volume of the calls and divide the two, and we get a put-call ratio. Now, you'll notice that puts are in the numerator of the fraction, so when there's heavy put buying, the ratio will go higher because that's in the numerator. But when is there likely to be heavy put buying? Well, that's when the stock market's going down, the stock's going down. So similarly with call buying, calls are in the denominator. So when the denominator of a fraction increases, the ratio goes down, the fraction goes down. And conversely, of course, when is there likely to be heavy call buying? Well, that's when the stock is going up. So we keep a 21-day moving average just in case there's something to Fibonacci. And this is ideally how things should look. We get this perfect inverse symmetry between the stock price and the put-call ratio. So here's how the signals work. Suppose the stock is going down, and as it's going down, people are buying puts, increasing the put-call ratio, and that's all fine. But eventually, the put buyers run out of gas, and you get a local maximum on the put-call ratio chart. That is a buy signal for the stock. And so then we get a buy signal for the stock, and it starts up. So move over to the left here, the stock's going up, and as the stock's going up, people are buying calls, forcing the ratio lower. Eventually it bottoms out. We get a local minimum on the put call ratio chart, and that's a sell signal for the stock. So that's how we interpret the data. Here is a chart of the S&P. This is not current. Chart of the S&P on top, and the equity only put call ratio on the bottom. And you can see the inverse symmetry that exists most of the time, and that's why we use the equity only put call ratio to predict the stock market. So here's the current chart of the standard ratio. We had a local, we had a huge local maximum back in March of 2020. So that was a very nice buy signal back there. More recently, we had one here, buy signal at the end of May. And then we came down, and right around the beginning of July, we got a sell signal. Now this is still open. The market has not gone down since then. So this is the first of what I'm going to show you, several indicators that are showing that the internals of this market are completely different than the S&P itself. What's causing this to go up? Well, people are buying a lot of puts on individual stocks. Remember, this is the equity only put call ratio. And in fact, a lot of stocks are actually going down. Very few stocks are performing as well as the S&P 500. In any case, this ratio has risen so far, it will eventually come over here and give a buy signal. So it might get itself back in sync with the market. Also, as the computers progress, we were able to compute another put call ratio measuring dollars being spent, not just volume. So at the end of the day, we take an options price and we multiply it times its volume to get a dollar volume. We use the closing volume and the closing price. You can do this all day long on tick by tick if you wanted to. It's pretty expensive to do that though. And we found this works pretty well. So we do that calculation at the end of the day. Again, let's say for all the options on IBM, we sum up the dollar volume of all the calls, separately sum it up for all the puts, divide the two, puts over calls, and we get the weighted put call ratio or dollar weighted put call ratio. And now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. So here's the ratio. Again, similar timing on the signals. We had a buy back there in March of 2020, had a buy here at the beginning of June, and then here around the beginning of July, we had the local maximum, a local minimum, I'm sorry, and you can see that that's, remember, that's a sell signal. So this one too has been on a sell signal, perhaps not as shooting straight upwards as the standard ratio was, but still advancing. So telling us, again, there's been a lot of put buying in the market. It's pessimism as far as individual stocks go, obviously not as far as the S&P goes. So historically, these have been very strong signals, and we did get those sell signals at the end of June. They're still in place. So not every indicator has a winning trade every time. This one is struggling with this trade, of course. Now, what do we buy when we buy and get a signal? Well, I'm in the business of predicting the underlying, whether it's a stock, an index, a future, what have you. And so I don't want to be right about the direction of the underlying and lose money on my option that I use to trade it with. So let's say we have a buy signal. I look at the delta of a call option. Now, a delta of a call option ranges between 0 and 1. 0 means it doesn't move up at all when the stock moves up a point, and 1 means it moves up a full point when the stock moves up a point. So I want to have an option that has a fairly high delta, because the higher the delta, the more the stock behaves like the underlying. And again, I'm in the business of predicting the underlying. I don't want to be right about the stock and lose money on the call I bought. So if you're buying options with very low deltas, you're buying more of a lottery ticket than trying to just convert your stock picking into an option trade. So for a short-term trade, let's say anywhere from 1 to 3 weeks, I'll try to buy an in-the-money option with a delta of 0.7 or higher. So on SPY, for example, buy 1 strike in the money, 1 point in the money, looking to buy an option with a delta of something in that neighborhood. If we're going to be longer term, like a put call ratio trade might be, could be up to 6 months. Then we'll buy an at the money option, but even there, an at the money call has a delta slightly more than a half. So in either case, if the underlying moves up, I'm going to be making money, and I'm not going to lose money if the underlying advances. So when do you spread? You see on TV all these guys are buying, they have a speculative trade, but they always buy a spread. And, frankly, that's kind of silly. No one really trades, no professional option trader anyway trades like that. Here's this picture here is what you do to your position. So if you have a long call position, it has limited risk. And if it were to just go way to the upside, you had unlimited gain. If you make a spread out of it, if you sell a higher strike option against the one you bought, the lower strike you bought, then you cut off your profit potential. So is that worth it? Most of the time, no. Most of the time, you do not want to be cutting off your profit potential on what potentially could be very good trades. I only use a bearish spread when the underlying volatility is very high. The implied volatility is high. Currently, with VIX up near 20 or so, at 19, I guess we're close to 18. We're looking at a fairly high volatility of VIX, and so I will still be spreading in this case. But you hear people say, well, I do the spread because I'm risking less money. Yeah, you might be risking less money, but you're still risking 100% of your profits, because if the stock goes down, whatever you paid for the spread is completely lost, or whatever you paid for just a straight long call would also be completely lost. But so you're risking 100% in both cases, and to fool yourself and say, well, I'm risking less money, that's strictly a money management function. Then don't buy as many long calls as you would have spreads and equal the money out. So I don't use spreads that often. And we had this week, in fact, in our the Option Strategist newsletter, we had a pretty good article on when to roll long calls and long puts that are profitable. And we use strategies like that as well. Turns out that, you have to be careful about doing that too often as well. So if you are going to spread, I suggest two things to help you out from cutting off your profit potential more than you have to. Widen the difference in the strikes. So for example, right now, if you're buying a SPY call spread and you want to spread it, have 11 to 13 points between the strikes. But if you're doing a put spread, you want more, because SPY implied volatilities are inverted and puts are more expensive. Out of the money puts are more expensive than out of the money calls. And so you want something like 20 to 25 points between your strikes. And then if you're in the position, a spread, and your short strike is hit, if the stock rises, you got to call bull spread on, and the underlying SPY gets up to this price, then you want to roll your spread. So sell the one you had and buy a new one. So the same thing goes on the downside if you hit your short strike, because once you hit your short strike, you pretty much don't have a whole lot of potential left in that spread. Yes, there's some due to time value, but not much. So by rolling when the short strike is hit, you'll still give yourself more profit potential if it keeps going in the same direction. All right, let's take a look at some individual put-call ratio charts. I usually like to throw a few of these in. Here's GPC. This is so in individual put-call ratio charts, we're looking for these extremes. So I want to see that this signal comes in. There's a buy signal right back here. That in the prior 600 trading days, that this is in the 90th percentile or higher of the height of the put-call ratios over that time period. So this one, even though it's a local maximum and would be a buy signal, that does not fit that criteria. That's just in the middle. So that's not a 90%er. So here's this buy signal is pretty decent. This one still qualified. Pretty good buy signal there. And now we've just had another one slightly higher than the second one, not as high as that one a year ago. But here I'm looking at the chart and I'm seeing resistance right around 130. So we combine technical levels with our put-call ratios, and we're saying we would buy this stock based on the put-call ratio, but only if it breaks out over 130. Here's another one. Now this one we just straight out bought. DHI has a pretty good track record, and you can see here this is a lot what's happened this this year and this last few months, you see the stock had a good run the beginning of the year and then backed off. Didn't back off that much. I mean, didn't even give back probably half that gain. But as it did, people were buying puts like mad, and they forced the put-call ratio all the way here up into the 100th percentile. So that's why we like that one in particular. And then it's already overcome. Well, there was a minor downtrend line there, so we're straight long that one. There's another one, Archer Daniel Midland. Again, very high put-call ratio, considering that the stock only backed off a little bit like that after a pretty long bull run. So again, we're long that one. And then you can do this with futures options as well. This chart at the bottom here, the put-call ratio chart, is constructed using gold futures options, the ones that trade on the COMEX. Now, doesn't mean you have to trade those options. You just use them to construct the chart. You see the nice high local maximum there. That's a buy signal. This is not a current chart. You can see gold did go up quite a bit more after that. And we were trading it with GLD options. So a lot of times you use the futures options to construct the chart to get your signal, but you can actually trade it with an ETF on the stock market. All right, so the third thing we look at is market breadth, and this has been another area of problem for this stock market. This market has advanced strongly this year without the help of much breadth, and that means that, again, the average stock is not advancing along with the S&P. So breadth is simply advances minus declines. We can do that to keep a cumulative total. That's one thing we can do. And the second thing, we can compute an oscillator. So our oscillator consists of today's oscillator value is 90% of yesterday's value, plus 10% of the difference between today's advances minus declines. So we use two different sets of data here. New York Stock Exchange data, of course, that's a very common way to get advances and declines. But there are things in the New York Stock Exchange data that are not stocks. So we also looking for a stocks only data set. And it turns out we have a perfect one, all optionable stocks. We look at those every day. So that's our stocks only data set. And this is the stocks only oscillator going back to 2013. So mostly a bull market all over that time period. You can see by our definition, if it gets below minus 400, that's when it's below this green line, and that's oversold. Had two massive oversold conditions not in the last few years. One was this right before Christmas of 2018. And then, of course, one was last year, March of 2020. Both cases were about equally oversold. And if you can believe that, that Christmas decline was pretty bad. In any case, as I said before, oversold is not a buy signal. We wait till it stops being oversold, so we buy there. So, we don't get the exact bottom, but we get in about here and have a good long ride upwards. Then the red area is where it's overbought. So each of these produce pretty strong overbought conditions. And again, overbought does not mean sell, so we wait until it stops being overbought. Kind of had a little decline like there, but it just kept on going. More recently then, so we came down here and breadth has been failing. So you can see the S&P chart on top was going ahead and making new all-time highs and everything, and yet breadth has been failing, declining down in here to where in late May, when we sold off that one day when the market was down almost 100 points, and then we had another sell-off here in June. I'm sorry, in July, where it was down 100 points. And so we had oversold condition, which we came out of that on July 21st, I believe it was, and that gave us a buy signal. So right now, this oscillator is long. It's on a buy signal because it was coming off an oversold condition and popped back up. Yeah, July 21st was the date of that buy signal. So our oscillators, typically when the market is making a new all-time high, these breadth things would be way in overbought territory. The oscillators would be very overbought, and that would be good confirmation. Right now, they're not, so it's not such good confirmation. But they're not on sell signals. That's about the best thing I can say for them. Cumulative breadth, remember, I said you can just add them up every day. So you just can do this, add them up every day. And what this is good for is spotting what they call a negative divergence in the market. Now, negative divergence means that the market's going up, but cumulative breadth has stopped going up. And we had many days in the last month or so where S&P was up, even making a new all-time high, and yet breadth, was negative. So that was not the case today. The market was up and breadth was plus 700. Not terrific, but still good. So, but back in June, we had a new cumulative breadth all-time high on 10 of 13 days, ending on June 11th. Since June 11th, we've had S&P go on to new highs, but these indicators have not. So it's now 38 days, 38 trading days have passed, and these cumulative indicators have not made new all-time highs. So this is a negative divergence. You're probably starting to read about it in the newspapers. I know there was an article in Barron's. Lowry's, the big technical analysis corporation, was sending out ads this week offering history of negative divergences and things like that. And it's not good for the market in general. However, we did have one in April that lasted for 28 days and didn't seem to be any really negative consequences to that. But S&P has made a new high 18 different times now since the cumulative breadth indicators have. So the way we treat this is, it's not a sell signal by itself, because as I'm going to show you in a minute, you don't know how long it's going to continue. However, when sell signals do occur, you need to be on the alert and take them and not ignore them. But so sometimes you may have heard the old saying, it's not good when the generals are leading. That referred to the old days of the Dow when General Motors, General Electric, General Dynamics were leading the way. That was usually a sign that the broad stock market was falling behind. Well, now we're falling behind, but the generals these days are the FANG stocks and Microsoft. So here's three charts that are kind of showing the same thing I'm talking about. We know that the S&P is making a new high. We can also see that the QQQ chart is, of course, that's got these FANG stocks in it, so that's making a new high. And here's the Dow. It's struggling, but it also made a new high. But the Russell 2000, which is much more indicative of the average stock, Russell 2000 had an 8% drop from late June into mid-July. Now, one perhaps encouraging thing is that there's that McMillan volatility band. It's given a buy signal in terms of the McMillan volatility band. But, right now, that index is still lagging well behind the other ones. So I mentioned this Lowry's paper, and in there, Lowry's points out that the longest divergence was 2 years, from September of 1927 September of 1929. Of course, we know that in October of 29, the crash began and the whole 94% decline into the bottom. But can you imagine waiting 2 years? I mean, if you'd have tried to short in there, you'd have been run over, and probably plenty of people were. The shortest one that in the Lowry study was 1 month, on the average of about 6 months. So as I said, we're about a month and a half into this one since June 11th, coming up on 2 months. And Lowry's contends that nearly all bear markets start with a divergence. I'm not 100% convinced of that. We're going to be doing some research of our own. But in any case, there is this divergence going on right now. S&P is merely going on to new highs, and the internals of the market are not really following along all that well. Now, the fourth thing and last thing that we look at is VIX. The trend of VIX is important, and VIX spikes on the chart are buy signals. So in that same vein we've talked about before, sometimes VIX gets very low. It has not done that in this bull run since March of 2020. But when VIX is very low, that alone is not a sell signal. That's just an overbought condition. So if VIX drops to 12 or even 10, that's not a sell signal by itself. You have to wait for it to start rising again. But here's the current VIX chart, and you can see, as I said today, VIX closed at about 18, so about right where it closed yesterday. And this chart has all these spikes on it. So those are all buy signals. We have a system set up to trade these. Has a really good track record. The red ones are winners, the blue ones are losers, and there's currently one in place, the green one, and it came on, I think around July 20th. My next chart will show, but that's those. You can see a couple of times we had a losing signal quickly followed by a winning one. Same thing right here. And then it just occasionally there's just a losing signal standing out there by itself. But most of them are winners, and we have a good track record with this. We keep very accurate statistics on it. Now, so the spike peaks, we have a spike peak by signal in place. That's pretty good. I mentioned the trend of VIX. So here's the 200-day moving average right here. And you can see that it's trending lower. So that means VIX is in a general downtrend, and that's positive for stocks. VIX trends opposite to the stock market. But you can see here on the short term, since the beginning of July, there's just been this little bitty short-term uptrend in place. So far, I'm not considering that to be much of a problem. But if VIX and this 20-day moving average were to cross above the 200-day, that would be a major problem. So there's still some distance between the two, and that's not imminent. But the last time that crossover took place was in February of 2020, late February 2020, right before that huge market crash with the pandemic. So this last buy signal is on July 20th, and it's staying in place. In fact, pretty much we've been on VIX spike peak buy signals consistently since May 21st, except for a couple of days. So you can see this is an S&P style indicator, and it's much more in tune with what S&P is doing than, say, those broad market indicators, which are much more negative because they're much more in tune with what the broad market is doing. So, as I said, it will be a major bearish sign if this crossover took place. That doesn't seem to be imminent right now. Another thing we're looking at, if VIX goes back into spiking mode, that can be a warning sign too. That would mean it would have to close above 2020. It didn't. It closed at 18, so not a problem. So one thing that some traders have been a little bit worried about is that VIX seems so high priced that it's 16, 17, 18, keeps bumping up into the 20s. But if you look at the long-term history of VIX, that's not so bad. It's just we've been since 2009 in a very, very, very low period for VIX, where it's spent let's say several years, spent most of the year at 14, 12, things like that. The last one being 2017, but even 2019, I mean, VIX was low for a long period of time that year as well. So I don't consider this a real problem with VIX being a little higher. It makes for better trading opportunities for option traders. So to me, it's a bonus, not a detriment. We also look at the prices of the VIX derivatives. You can't trade VIX itself, but you can trade the futures and you can trade the options. So there's one thing called the term structure and another thing we call the construct. So in a normal bull market, VIX would be sitting here as it is today at 18, and then the front month future might be 20, and the next one 21, 22. So the term structure of the future slopes upwards, and they're all trading at a higher price than VIX. That's normal, that's bullish. When the opposite happens though, and this happened in, of course, 2020, March of 2020, VIX is very high, and then the futures were priced at lower levels, and the term structure was sloping downwards, and these were all trading at a discount to VIX. That's very negative. So the crossover from the bullish to the bearish period is something that we look for. I'll talk about that more in a minute. But here's last night's closing prices. VIX closed at 1946 last night, and you can see that the front month futures, the August futures here in white, closed at 21.14. So if we subtract the price of the future minus the price of VIX, it's plus $1.68. So it's trading at a premium of plus 168. By the way, the way the VIX futures work is they're priced on SPX options that expire a month later. So they're pricing off the September SPX options. In any case, you can see that the term structure slopes upwards here because each one is higher than the one before, pretty much, except for that one. And so that's positive. So the premiums are getting larger as you go out in time, and the term structure is sloping upwards. That's all bullish. All that stuff is positive for the stock market. Now, if you don't have access to the VIX futures prices, you can look at the CBOE volatility indices. They publish 5 of them. There's a 9-day index. VIX is a 30-day index. There's a 3-month, a 6-month, and a 1-year. And these are, you could quote these just like you quote S&P on your quote systems. And you can see these all slope upwards as we go out in time as well. So that term structure is sloping upwards, and that also is bullish. So all those things are good. So the construct is bullish. It would, however, be a major sell signal if the front month futures were to jump up and go higher in price than the second month futures. That's not, I wrote those prices down this afternoon about 1 o'clock, and they closed more like 19.95 and 21.95. So still a 2-point difference in the front month is very bullish and not a problem at all. So just to summarize here now, all these things we've been talking about, the S&P chart is bullish as long as it remains above 43.70. We have sell signals from the put-call ratios. The oscillators are, breadth oscillators are weakly on buy signals. VIX has a spike peak buy signal, and its trend is still downward, so that's bullish. And the construct, the term structure we just looked at, that's bullish. So by and large, these are all bullish except for the put-call ratios and maybe breadth. But as long as S&P is above support, we have to consider that indication to hold a core bullish position. And we do trade some short-term signals against it, but we are holding that core bullish position as we go forward in time. There's another indicator we can look at with realized volatility. We've just gotten a sell signal from that. This is going back 2018, 2019 on this chart. And you can see we had a few sell signals, including the marked here, including one right before the crash. Yeah, that actually came in January of 2020, so the market didn't crash for over a month later. So we just, here's the current one. We just got a sell signal here. I believe that was on something like July 23rd or something like that. Realized volatility, you can see, is starting to creep back up. And we see that with implied volatility too in VIX. But this actually, we have an indicator based on our research, and that gave a sell signal. And just one thing, if you're looking for a kind of a safe bearish strategy, this one is about as good as they get. Nothing's perfect, of course. But if we, let's say now in early August, if you put this position on, you buy 2 out of the money October puts and sell 1 at the money, or not even at the money, but 1 put with a higher strike, so that the 2-by-1 is even money. You have a position that doesn't lose if the market goes up, because you put it on for even money. If the market goes up and all the puts expire, you don't lose anything. On the other hand, if the market gets creamed, you're long 2 puts and only short 1, so you can make a lot of money on the downside. Where's your risk? Your risk is right here. It's close to the 390 strike. And what we're going to do to minimize that risk, but not eliminate it, just keep it to a lower level, is we're going to roll the whole position at September expiration. So we're not going to wait for October. And so at September expiration, we'll put one on in November, and we'll keep doing this. And eventually, if the market breaks, we should have a pretty nice profit. So we're coming into the fall. Fall is usually a problem for the markets. This could be a pretty good position to have on at that time. So I mentioned the offer that we're making. It's 50% off this new home study course. Just go to optionstrategist.com/festival. And the coupon code is festival. If it asks you for one, it really shouldn't. We also have newsletters there. We had a great track record last year in our Option Strategist newsletter. We have a YouTube channel. We record on Mondays. I invite you to subscribe to that. And we've got a couple of other new newsletters that are doing quite well as well. So, as I said before, go to the optionstrategist.com/festival. If you're interested in money management, we have a different website you can go to there and fill out a form.